Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Welcome back to the Jones Zone. If you haven't caught part one of this conversation with real estate tax attorney Michael Kelly, make sure to go back, check that out first. In today's episode, we're continuing our deep dive into California property taxes, focusing on the intricacies of transferring property into trust, avoiding reassessments, and answering listeners' questions about inheritance and Prop 19. If you're a property owner in California, this episode could save you a lot of headaches. Let's get started.
What tax implications should someone consider when transferring real estate into a trust?
Great question. And not a lot of people know this or pay attention to this. So it's something definitely to be aware of. For property tax purposes, we look through trusts as to who owns the property. So if you have a property owned by a revocable trust, we look to the trustors of that revocable trust as the owners. And this is just high level, generally speaking. There's some complex trusts out there. Generally, for property tax purposes, what we're looking at is the trust revocable or not. Again, for revocable trusts, it's the trustors of the trust that are the owners for property tax purposes. If a trust is irrevocable, it's the current beneficiaries that are viewed as the owners for property tax purposes. You want to look at whether the trust is irrevocable or not that you're transferring it into, and how that might change the ownership from before the transfer and after the transfer when you carry that transfer. Because if the trustors are different from who own it before the transfer, then that's going to probably cause a reassessable event. And this is one of those where you record a deed that says Mary and Bill own a property as tenants in common, and they're transferring it into revocable trust wherein it doesn't say the trustors. It would usually say to the trustee of the trust, which for property tax purposes, trustees don't matter. It's trustors that you're looking at. But let's say the trustors aren't Mary and Bill. The assessor's office is likely going to send out a letter saying, hey, we want a copy of the trust. We want to review whether this was a reassessable transfer or not. And if you're doing things the right way, you'd send them the trust. They'd see that the trustors are different and they'd reassess the property. But if it was Mary and Bill on a property transferring it into their revocable trust, wherein Mary and Bill are the trustors of that revocable trust, it's technically not a reassessable event. The ultimate ownership of the property remains the same for property tax purposes, because again, we're looking through that revocable trust at who the trustors are before it was owned by Mary and Bill. After it's owned by Mary and Bill through their trust, no reassessable event. That's something to be paying attention to when dealing with trusts. Now, let's say Mary and Bill own a property and they want to transfer it to their irrevocable trust that was set up for the benefit of their kids. Their kids are the current beneficiaries of the irrevocable trust. That would be a transfer from Mary and Bill to their kids pursuant to whatever terms that irrevocable trust calls for. Kids to enjoy share and share alike equally, then it would be a transfer of their interest to those kids share and share alike, and it would be reassessed 100% subject to some parent-child exclusion that might apply, which you could qualify for technically under Prop 19, and you should apply for if you do. That's the main rules. We look through the trust and determine who the property owners are.
Okay, that's huge because, I was talking to a state attorney about how much better it is to have to hold title for certain people, for certain situations, typically for the heirs, actually, to hold title in the trust on their houses or their real estate for when they pass in order to properly transfer it to their heir, as opposed to not having a trust and then having it go through probate, which oftentimes definitely always takes longer, and it costs a lot more. So knowing that now, for example, if I have a house where I own it, my wife and I own it, and we want to transfer it into our new trust, then that shouldn't cause a trigger to reassess the value. So our property taxes shouldn't be going up, correct?
So long as that is set up in that way, and that it's a revocable trust and you guys are the only trustors, so the ownership shouldn't change. That shouldn't be a reassessable event. Now, what you could encounter is you do that transfer, the assessor's office sends a letter to you asking for a copy of the trust to determine whether or not it truly was proportional or the same ownership, and you don't respond in a timely manner. They might say, "Oh, you're lost. I'm going to reassess it because I don't know one way or the other," and you get a notice of reassessment. And then you say, "Hey, wait, hold on. This was our trust, ownership didn't change." Then you'd have to retroactively go back and fight it. Make sure you file a timely appeal as of the notice date or the bill date of that reassessment and do it that way. But generally speaking, pursuant to the property tax rules, it should not cause a reassessment, again, assuming you answer whatever questions they ask.
Let me ask you this, because I've come across this before. If a family has parents that have been diagnosed with a terminal illness, so let's say my parents have been diagnosed with a terminal illness, would they be better off financially or tax-wise to not transfer the properties until after the death or the demise of the parent? So for example, I know a lot of people have asked me, they said, gosh, we need to get my kids on title because I'm not going to live too much longer. So we're going to put them on title now. And really, generally speaking, the answer is, well, no, you just make sure it's in a trust And I know this, you probably need more details and more facts, but generally speaking, no, you just leave it as is. If it's in a trust, especially, and just, upon your death, they'll handle that. Fair to say, kind of?
So not for property tax purposes. For
Okay.
income tax or estate tax, gift tax, that kind of stuff, that might be relevant advice. But for property tax purposes, the death is going to cause a change in ownership event, and it's going to transfer pursuant to whatever document out there exists that they've set up to transfer it, or through intestate succession if they haven't set anything up, in which case, like you mentioned, it goes through probate. For property tax purposes, they might benefit financially by doing something earlier, like taking advantage of a joint tenancy rule or a legal entity rule, assuming sufficient time exists to get the kids on title using one of those separate exclusions to avoid an issue caused by Prop 19. Maybe they don't qualify for this property under Prop 19, or the value is so in excess of the exclusion allowance under Prop 19, they wouldn't really benefit. They still wouldn't be able to afford the property. You could, again, proactively take advantage of some of these other exclusions, assuming you have enough time to try to avoid a reassessment that way. And when I say assuming you have enough time, these additional options, the joint tenancy rules or the legal entity rules, sometimes require multiple steps in order to get it from one person to the other without a reassessment. But you want to space out those steps to avoid encountering the steps transaction doctrine. Because again, if you do them too close together and the assessor notices, hey, there's no independent reason that they were doing these individual steps other than to avoid a reassessment, I'm going to argue the step transaction doctrine. I'm going to assert that and reassess the property anyways. If you're given 2 weeks to live, you might not have enough time to implement those steps without avoiding the step transaction doctrine.
Another thing to do to get more time is just don't pay your doctor, and he'll give you another 2 weeks to live.
That might be an option.
All right.
Yeah.
Sorry, you were saying, was that did you conclude your answer there? I didn't mean to interrupt.
So. Yeah. I mean, you're not going to be in any worse off position if you decide to try to implement those steps in a short amount of time. It's possible the assessor decides not to reassess you or argue the step transaction doctrine. You wouldn't be in any worse off position than you would be when the property ultimately transfers upon the death, which again is what happens for property tax purposes. But you're likely to encounter the step transaction doctrine if they're pretty close together. If you're doing them all on the same day in separate deeds, or you're doing them back to back within a week. They're clued in enough to these rules to know that people are really trying to just circumvent the rules when they carry it out in this way.
Prop 19 affects the transfer of property taxes between parents and children, or grandparents and grandchildren. Any more insight on that?
Yeah, so like I mentioned earlier, it severely limited the parent-to-child exclusion that was once enjoyed by Californians under Prop 58. That was the old parent-to-child exclusion in Revenue and Taxation Code Section 63.1. Now Prop 19 in Revenue and Taxation Code Section 63.2 had two major changes. The first is it eliminated the ability to transfer investment property, non-principal residence property, from parents to kids or from kids to parents. If it wasn't occupied as a principal residence by the transferor, it doesn't qualify for the exclusion. And the other is it capped the value of property that's transferable between parents and kids or kids to parents. And that capped is measured by $1 million plus the trended base year value of the property immediately prior to the transfer. The calculation is you compare that exclusion allowance, 1 million plus the trended base year value, to the fair market value of the property at the time of the transfer. And if the fair market value is less than the exclusion allowance, then you fully qualify. Just like under the old rules, you can keep the Prop 13 base transferred from parent to kid. The fair market value of the property is in excess of the exclusion allowance. It's more than the $1 million plus the trended base year value. Then the property is going to get partially reassessed by that delta. Whatever the delta is between that fair market value and the exclusion allowance, that gets added on to the trended base year value that child inherits. And that's the new taxable value that they pay tax on under Prop 19. And so that's how it works. But it used to be able to transfer a principal residence of the parents to the kid as their principal residence within a year of the transfer. And so those are the major changes under Prop 19 people are grappling with and trying to deal with. And if the uptick under Prop 19, if the delta on that fair market value and the exclusion allowance is too high, it still might be worth it for people, and the kids might not be able to afford that tax hike even under Prop 19. It's really impacted a lot of families. And I should note that the exclusion allowance is adjusted every other year. As of February 16th, 2021, which is when Prop 19 first took effect, it applies to all transfers that occurred February 16th, 2021 and thereafter. It was set at $1 million. Every other year it's adjusted by the house price index, the percentage reflected in the house price index. And so as of February 16th, 2023, it was adjusted up to $1,022,600. So that's the new exclusion allowance we operate under. It's that value plus the trended base year value that you're comparing the fair market value of the property to at the time of the transfer. And so in February 16th, 2025, it's going to increase again. We don't know what the percentage is going to be, but the exclusion allowance will now increase. And that's, some silver lining, I guess, to give people a break for inflation. As property values increase, they recognize that should probably be reflected in the exclusion allowance because it's compared to the fair market values of these properties. But it's a small token to the significant limitation that was imposed by Prop 19 on this exclusion.
Do property taxes differ between residential and commercial real estate here in California?
They do not. No, they're all subject to Proposition 13, which again limits the tax amount to 1% less bonded indebtedness, limits the annual increase to the lesser of 2% or the CPI index, the inflation factor for any given year. So whether it's commercial, residential, industrial, they're all taxed the same way. They're just taxed at different values and assessed at different fair market values upon the relevant change in ownership event.
All right. So I also announced that I was going to be having you as a guest, and I asked some folks on social media if they had any questions they wanted me to ask you, and I want to go ahead and shoot those to you. One person asked, how long does the residence need to be in my name till I can release it to my kids and move out of state?
There's no set amount of time for a property to be in your name. And again, if you're looking at the parent to child exclusion under Prop 19, the property has to have been your principal residence at the time of the transfer. The way you designate a property as your principal residence is you file for the homeowners exemption. There's no set time that you have to occupy a property as your principal residence to qualify for the homeowners exemption. You just have to be occupying it as your primary residence and intend for it to be your primary residence, the home that you go home to every day after work.
I think it's important to let people know this has to do with property taxes. I'm not sure if the listener posed that question for any sort of inheritance tax or anything like that, but I just wanted to say that.
Yeah, this is limited to property tax and avoid a
Okay.
reassessment and to be able to qualify for the parent to child exclusion.
Another question from the audience. Do you need to be a parent-child exemption if the child is put on the title?
Yes, you do. If you add a kid to title, transfer 50% to the child. So it's mom and dad and kid, 50% mom and dad, 50% kid. That's going to cause a 50% reassessment unless you file for the parent to child exclusion. And we didn't really talk about the parent to child exclusion deadline, but they're the same both under the old rules and the new rules. You have to file for the exclusion within 3 years of the transfer or before a subsequent transfer to a third party. And if you miss that timeline, there's a catch-all deadline to file, and that's within 6 months of the mail date on a notice of supplemental or escape assessment. So if you've missed the 3-year deadline, more than 3 years passed since you added the kid, but the property hasn't been reassessed, and later on after the 5th year, the assessor gets around to reassessing it, you have 6 months from that notice date on the supplemental or escape assessment to file for the exclusion and still qualify. And if you miss both of those deadlines, you can still technically file, assuming you qualify under the homeowners exemption rules that we talked about earlier. You moved in within a year and filed for the homeowners exemption. You can still file after those deadlines, but you're only going to get prospective relief. So you get relief as of the assessment year that you file in moving forward.
If one sibling wants to reside in the home and the other sibling or siblings just want the money split equally, what is the best way to handle this with the current changes in the property tax Prop 19?
So that's a great question and something a lot of people encounter. Kind of alluded to, it could get complicated if you do a non-pro rata distribution. But if you have a property that was owned in a trust, the parents devise in the trust that it transfers to their kids, share and share alike. The kids don't want to take it share and share alike. One kid wants to live there, the other kids just want money. And the trust allows for a non-pro rata distribution. You can do so, give the one kid the property, give the other kids money, but the trust has to be fully equalized. So the distribution has to stay from within the assets in the trust. So you could give one kid the house and give the other kids money, but it has to be money from within the trust. So let's say you have other bank accounts and other assets that add up to the equity in the home that the other kid's getting. You can distribute it that way, assuming the trust allows for it, and still qualify for the exclusion. But if you don't have enough assets in the trust to fully equalize, get everyone their equal amounts that they were supposed to get pursuant to the terms, then you would likely have to mortgage the home, give the kid the home subject to the mortgage, the kid that wants it, and distribute that loan to the remaining kids who want the money instead, so that everyone gets an equal amount. The kid who gets the home has equity in the home subject to the mortgage. So the value of the home less the loan, that equals the money that the other kids got. But the loan has to be taken out in the name of the trust. One kid can't go out and take out a loan and give it to the other sibling in their own individual name, because that's viewed as a sibling to sibling transfer. But if the trust allows it, the trustee can go out and take a loan, usually on a hard money loan. It's the only ones that will allow it, and distribute that loan to the kids so that everyone gets equal and qualify for the exclusion that way. And you can describe it to the assessor's office. Hey, trust allowed for a non-pro rata distribution. This is how everyone got equal amounts. We made sure that the pennies all add up. Let us qualify. And again, that's still all subject to the other limitations under Prop 19, but you can technically still qualify for the exclusion if you want to do it that way. Otherwise, you just have all the kids take title equally like the trust called for, and one kid lives there and the other kids go off and do their other thing, and he just knows that his siblings are on title and you don't have to deal with that other stuff.
Another question from the audience. So my parents have multiple homes, 2 homes plus 1 primary residence for a total of 3 homes, which has produced passive income. How can my sister and I keep all 3 inherited homes for passive income to split amongst my sister and myself?
So like we talked about, only the primary residence is going to qualify for the parent-to-child exclusion under Prop 19. And then again, that's assuming only that one of those kids moves into it within a year of the transfer, which sounds like maybe that's not what they're looking for. So you'd have to take advantage of one of these other rules, the joint tenancy rule or the legal entity rule, proactively to set it up in a way that when you ultimately inherit it, either through that joint tenancy right of survivorship or through an inheritance of the legal entity interest, there's no reassessment that way. That would be the only way to transfer these investment properties without a reassessment.
So another question from the audience, how can we avoid paying stepped up Prop 19 taxes when we inherit income property in California? I think you may have addressed this, but
it's being proactive, recognizing that this might be something that will happen in the future eventually, that you might inherit this property. And before you inherit it, before your parents pass, setting up the ownership of the property, getting the transferees on title ahead of time using one of these other 2 exclusions, the joint tenancy exclusion or the legal entity exclusion. And that's really the only way these days to avoid increase in assessed value, the reassessment event caused by inheriting property subject to Prop 19. You could still qualify for some benefit under Prop 19, but it might not be enough for you. So you have to try to explore, go out, think outside the box and use some of these other rules to potentially avoid a reassessment.
I'm guessing that something like that is what your firm takes care of or does. Or is that something your firm helps with?
It is. So we work with a lot of trust and estates attorneys who get these questions from their clients who don't have the property tax expertise, but are able to draft the deeds or set the trust up in a way or create legal entities to help lay the foundation to take advantage of some of these other rules. And we'll work with them to review the documents, make sure they're doing it in the right way for property tax purposes, to ultimately get the property transferred over to who they want to get it to, and with the hope of avoiding the step transaction doctrine and avoiding a reassessment. You can never fully eliminate the risk of the step transaction doctrine, no matter how much time you build in between each of the steps. But the more time you build in, the less likely it is that you'll encounter it. And we try to work with folks to give themselves the best shot to take advantage of those rules and set them up for success in the future, in future generations.
All right, Michael, that was absolutely fantastic. This was probably one of the most informative podcasts I've ever done, because this is really, really important stuff. Any of our listeners want to hire you or contact you, what's the best way to reach Michael Kelly?
I appreciate that very much. It's been a pleasure being on, and I appreciate you having me. Michael Kelly, lawyer with Agilot, Pauley, AU, Matarisi, and Broche. That's our law firm. We handle solely California state and local tax. About 80% of our practice is property tax. We do some sales and use tax and some city business tax, but most of our practice is property tax and documentary transfer tax. I can be reached via email at Michael, Michael, at apataxlaw.com. It's A like Apple, P like Paul, A like Apple, taxlaw.com. Or our phone number, you can call into the office. That's 818-553-1300. Happy to answer any questions anyone has. If you have something that's just bugging you or you're stuck on something, we're happy to chat with you through it, see if we can help you, and get engaged if it works.
Awesome. Well, I think hopefully you'll be bringing off. In fact, I think that's your phone ringing now. No,
yeah, exactly.
All right. Well, thank you so much for joining us. This has been great, and sincerely, thank you. So everybody tune in. And if you haven't hit that subscribe button, please do. It really helps us get this information out to more people and hopefully help them out. So thanks again for watching and listening. And till next show, thanks. Bye-bye. We'll see you later.
Thanks a lot.
All right. See ya.
That brings us to the end of part 2 of our conversation with real estate tax attorney Michael Kelly. In this episode, we tackle even more of your questions about property tax assessments, trust transfers, strategies to preserve family wealth through smart real estate decisions. If you haven't listened to part 1 yet, make sure to check it out as it lays the foundation for everything we discussed. Thanks for tuning into this 2-part series. Be sure to subscribe so you don't miss out on any future episodes. See you next time on the Jones Zone.